Welcome to the Money Insights Podcast, where high income earners come to learn wealth building strategies that will take them from high income to high net worth. With your hosts, financial and wealth building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast. We talk all things money and business. My name's Christian Allen. I'm here with Rodney, the pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great. How are you?
Okay, can I be honest with you? I'm a little frustrated today.
Oh,
And my reasoning, Rod, is because I was trying to follow Adam Carroll's advice. I am following Adam Carroll's advice and decided to use the shred method.
okay.
So I decided, okay, we got to get a HELOC, right?
Uh-huh.
And I was not very happy with the valuation I got back.
Oh, I see.
It was quite disappointing. In fact, Rod, I thought, and I am shocked that I was this far off, but I thought it was going to be about $200,000 higher than it actually was. Crazy. So anyway, I'm a little annoyed today. But
Yeah,
other than that, I guess I'm good.
Hopefully it gives you some room for shredding some debt.
Yeah, we can still shred some stuff. It was just
Yeah, I
can't
get
believe.
you,
Okay,
valuation.
so just to kind of give some reference point, I got this house in 2021.
Okay.
It was 1.2 million, right? I did the basement, we did the outside. We put a lot of money into the house.
You did.
In a lot of ways.
Yeah.
And we came back. This was really funny. The AVM at the time, which is just kind of what the banks use as like a baseline, was much lower. It was like $1,060,000 or something like that. This is just a little. Then we got our first appraisal back around. And it was 1.225. So we had gotten a little bit of quote unquote equity. Obviously, doesn't really matter because you're not using it. But
and you spent a lot of money to get there.
Yeah. But either way, we bought it at 1.2, and it was immediately appraised at 1.225. Right.
Okay.
We do all the work that we put into it. The AVM comes back at 1.35. That's what the bank says. And we're like, there's just no way that we're that low. So we might as well do the appraisal. That way we could, potentially get more out. We don't really need this line of credit. We're just doing it for shredding purposes, right? But we figured you might as well get as much as you can anyway.
Right.
That's the plan. Okay, Rod. So the AVM 1.349. We then do the appraisal. And it comes back after, Rod, I hate to say this out loud, but I probably put $300,000 into the house since we bought it. And it came back at a whopping $1,308,000, less than the AVM.
That is disappointing.
I have no words. It doesn't seem like it's quite accurate with what I'm seeing around here, but here we are. This is the life we're living, Rod. What that tells me, though, is that real estate has to be going down, despite what the real estate people want to tell you, that like it's still plugging along. Like it's dipping for sure.
Well, especially if they have comps out there, right? So there are people who are giving up what they probably maybe they originally listed it higher, but they're having to give up some of that to get it sold. So that tells
it's interesting.
Me,
it's crazy. Anyway, so that's why I'm a little bit grumpy, but I'm going to get out of my grumpy mood and I'm going to focus on some good stuff. So let me set the stage for today, Rod. Actually, before I do that, a couple of things. Everybody, make sure if you are not part of the Facebook group, go become part of it. It is Investment Strategies for High Income Earners. That's the Facebook group. We got a bunch more traction. I think we have 400 people or so, something like that. So we're getting some people in it, but we need to keep growing it. And then as we do that, we'll do some cool stuff. In fact, one of the things that we're going to switch up is we're going to stop doing our weekly Facebook Live. And instead, we're going to do probably a monthly webinar that we'll do more promotion around. We'll put a lot of preparation and time into it and make sure that we're really delivering value. So that's just kind of something to be looking for, probably starting in the next, less than a month, I'm thinking.
Yep.
Sound good, Rod? Okay. Did I miss anything else? Oh, encourage questions. So today's episode, we're going to be continuing on the conversation we had with asking Rod the tough questions. So for a reference point, if you didn't catch the previous episode, I've been doing a bunch of reading and listening, and I've just been gathering questions and ideas, thoughts that I want to get Rod's opinion on. And I have pretty strong opinions on them too, but we're going to start with Rod's opinion. And man, I've got a long list. I've got a laundry list of questions and ideas and things that I'm hearing out there in the mainstream financial world that just are making me roll my eyes. And I'm hoping that, like, I'm trying to put my faith in you, Rod, that you can come and deliver something that I can say like, yes, I agree with that. So anyway,
I'll do
today
my best.
we're going to continue that on. Without further ado, Rod, let's go to the question. Okay, one last thing. If you have questions, just go ahead and send them into rod@moneyinsightsgroup.com. That's right.
Yep.
rod@moneyinsightsgroup.com. And he'll be great at getting back to you with responses, or we'll bring it onto the pod.
Yeah, absolutely.
Okay, Rod, let's do this. I don't even know where to start. I'm just going to start picking questions because they're all really good.
Okay. All right.
Here we go, Rod. What percentage of my income is reasonable to put toward my mortgage? There's a lot of talk out there on this.
Yeah.
So what does Rod say and why?
I mean, I've heard of a lot of different things, and I heard it mostly when I was first married and didn't have a home. And we were trying to figure out, okay, when is it going to make sense for you? You want that, right? At least I did. I guess there are probably some people out there who feel okay with renting or whatever, but I felt this like drive to get into my own place, be building some equity. And yet, I was not far out of college. Maybe, when we bought our first home, I think I was maybe a year out of college making, $40,000
the big
a year
bucks.
or something. Yeah.
Yep.
And I remember, I don't remember exactly what the percentage was, but it was high 50s, 60% or something of my take home, like the net income that landed in our bank account, in that deposit that we were putting toward our mortgage. And people said that's nuts, right? Like a lot of the gurus would say no more than 30 to 40%. I think would be like a high water mark that they would
I think that's
allow
probably
people
true.
to stretch to do something like that. But more,
hey, Rod, to be fair, you probably took your mortgage out right in the middle of the worst lending practices in history.
We were actually right before that.
Oh, okay. Gosh,
so this was
you're so old, Rod.
I know I am. So this was in 2001, I believe, that we bought, end of 2001, that we bought our first home. And it was actually good timing as it relates to just like we got into that first home, and a couple of years later, we decided to build a home, and we had gained probably 20-25% equity or increase in value, but just in that couple of years, and transferred that into the new home, built that in, and we knew we were building it for someone else because we wanted to get somewhere else eventually. People heard me tell my story. We wanted to have our own business, and it wasn't going to be where we were. So anyway, it was pretty good timing until we got to that next place. So gratefully we got to that next place, and that's when everything came crashing down, and we were quote unquote stuck there but we were grateful. We were kind of at the place we wanted to be anyway. So.
Okay. So what's your answer, Rod? What should, if you're giving
I would say
the
recommendation,
general public,
I would say, I mean, if you could do it for 30%, that would be a reasonable number. Going 40 to 50%, you have to really be disciplined in everything else that you're doing in your finances to, feel good about that. So again, going back to our situation, we didn't have a car payment. We didn't have student debt, right? We didn't have a lot of things that I know a lot of people do have and would obviously impact that number. So I'm going to say 40 to 50 would be high.
Okay. So here's my take on this, really quick, and then we'll move to the next one. I think it's different. It's pretty drastically different depending on the person, situation, and income level. Obviously, if I make, if you're making a couple $100,000 a month, as an example, and you have a little higher percentage that goes toward housing than the average, as long as there's significant enough money to do the other things that you need to,
right,
then you're probably okay. Now, That said, I'm not suggesting that going, 50% makes sense. I would say 25 is probably good. 25, 30% is probably a good number.
Yeah.
I know Guardian, the life insurance company, they have their program, the living balance sheet, and they say 15%.
Yep.
No more than 15% on living. So, okay. And anyway, I think that 30 is a good number. So we're going to stick with that. Okay,
Sweet.
Rod, next one. Let me get that one off the board. How much should I have in my emergency fund?
That's another great question. And again, obviously this one depends as well. So for someone who is a W-2 income earner where you're not having to take responsibility for a business or, like this extra stuff. I mean, I would say, again, it depends, right? Because if you don't have a lot of expenses, but for our crowd, I mean, I would say somewhere between 50,000 and 100,000 would be like a reasonable emergency fund, right?
Yeah.
Something
Okay.
happens, I need to tide things over for several months, then I think that would be a reasonable number.
Okay. So my number, Rod, is 6 months of savings in your emergency fund. Now, let me be clear. Emergency fund doesn't have to be the savings of the bank. My emergency fund could be in other places that actually create real value. We talk about life insurance, obviously, being a good one.
Yep.
So that would be a great place to hold it. And if you did that and you're earning, like actually creating additional value, then, even going higher than that is pretty reasonable.
I have a
And
question
like you
for you
said,
back on that.
especially if you have a business.
Oh yeah,
Okay,
then it takes a different level because then it depends on like what your monthly
your payroll and everything. Yeah.
a bunch of stuff like that, overhead, all those things would come into play. And so
Okay.
I think it's not unusual to have a couple $100,000 fund
Sure.
for a business like that who maybe their revenue is 2 to 3 million a year or something, right?
100% accurate, Rod. Okay, what was your question for me?
Yeah, so I have a question back. Would you include in that? So when you say emergency fund, we always think about cash sitting in, like you said, a bank account or a cash value life insurance policy. Would you include access to debt in that? And specifically, like, I mean, obviously credit cards could be part of that, but even like having a line of credit set up at your bank.
Yes, I think I would.
Okay.
Now, obviously, from like a get to it in like as quickly as possible. Maybe it's a little slower, but you can get to your line of credit, basically as quickly as you can get to your any other money at the bank,
Yeah.
right?
Yeah.
So with that being the case, yeah, I absolutely think it makes sense.
Yeah. Because basically we're talking about liquidity. And that, so I would agree.
As long as it's there, as long as you have it available, you can cover those difficult situations that may come up. Because again, you've just got to be able to cover emergencies and have a path back, right?
Yeah.
So as long as there's enough there, then or as long as it's a piece of the total pie, then I think it's great.
Yeah, because I've heard people talk on this, and they would recommend to people to not even set up those kinds of lines of credit. And to me, I just always felt like that was one of two things. The biggest thing I think is probably that they wouldn't trust themselves to not tap into it, because otherwise it's just an opportunity sitting there that you can use if you want to. But if you don't, then it's just you're not paying interest on it unless you take money out, right?
Man, Rod, you are teasing us perfectly for my next question.
Okay, so that was number one. Or the second one would just be, like you mentioned a minute ago, not having a way to get back out of it. So if you did need to get into it and then got stuck, and all of a sudden you have this, whatever interest rate on this line of credit,
now you just increased
a problem.
your debt. But here's the thing: if you were running down that path anyway, like you probably were going to run out of it regardless. So like you might as well try to tap into it, cover the expenses, get yourself back on track if it's possible. Doesn't seem like a lot of downside. I do get the idea that you don't want to, if you're not someone that has any discipline, that's not fair. If you're not a person that has enough discipline to avoid overspending, then you're right. It might make more sense to just avoid that altogether. But Rod, that is what gets us into our next question.
Sweet.
And this one's one that we could go deep in this one. we'll just see how it goes. Okay, you ready for it?
I'm ready.
Is personal finance more about the numbers or is it more about behavior?
Ooh. All right.
Is personal okay, one more time. Is personal finance more about the numbers or is it more about individual behavior? Because that's really the debate we were just having, right? Should I
Yes.
set up the line of credit and do I have the ability or the discipline to not tap into it for something that's not important, that's not an investment opportunity? Can I do that? And if it's supposed to be my emergency fund, can I leave it there as my emergency fund?
Yeah.
So
This
that's
is a great question.
But it's so much deeper than that too, Rod, because you think about when we get to the question about mortgage, like whether I pay off my mortgage or whether I take more money and invest in it, or all basically, any type of investment or strategy or whatever, it comes down to, generally speaking, both the numbers and the behavior, right? They kind of have to come together. But the question again, and I'm going to make you pick.
Okay.
Okay. You can't say both. That doesn't work. Now you can give us some context.
I mean, yeah.
You could maybe lean one way. So I'm willing to let you lean one way, but you still have to give us an answer. And then I promise I will also give an answer. I've thought a lot about this one.
Okay. Well, I'm going to surprise you on this because I am going to pick one.
Okay. Oh, good.
Okay.
Gosh, I am excited.
And I mean, okay. So first, my inclination would be to say both because clearly they both matter. That's why it's a debate, right?
Yep. Yeah.
But I would say it's more about behavior. And here's why.
Okay. Yeah. Tell me.
The numbers, clearly important. They have to make sense. But I think it's more about the plan and the decision-making around the numbers that makes it work, right? So go back to what we were just talking about a minute ago. If you have that line of credit and you're just willy-nilly using it with no plan, with no foresight into what you're going to do to pay it off or whatever, then you can dig yourself into a hole and create credit problems and all kinds of different things like that, right? On the other hand, if you have, like we use the word discipline, that's obviously a critical piece. And part of that discipline is to going in, you know what you're going to do. You have a plan, right? And I would say in most cases, you would also think about a backup plan. I'll give you another example. And on the investment side, I talked with a lot of people every day, right? And these days, the big thing is that people will express their thoughts about how their investments are going right now.
Right.
And I get it. Like if you're in an investment and they have a capital call or they're having to do a fire sale or something, and you're looking at hoping just to get back out what you put into it, there's a lot of anxiety around that, right? And I totally
get
that.
That what you're feeling right now?
Well, not personally, like I don't.
People almost not you personally, but as you're hearing from clients, our investors, that they're just like hopeful to get their money back out of their syndication deal or whatever right now.
There are those who are coming to the conversation feeling this and just really frustrated and anxious about it. And I totally get it. Again, I'm not suggesting they shouldn't be frustrated about that because there were expectations going in. They put money out. It's money they don't have now to do anything else with, et cetera. There's, again, hoping to get back out what they put in. On the other hand, a lot of it depends on your expectation going in. Okay. So for example, when I invest in a syndication, I hope that there's a turnaround on that within 2 to 3 years. That would be great. Even 5 years, but I plan on more like a 5 to 7 year cycle on that money coming back to me. Right. And understanding the risks and changes and other things that can happen over 5 to 7 years, that's a long time, right? It feels like it passes quickly, but in the economy in general, right? So I think a lot of it is the plan going in, the expectation going in, and then also being open to contingency plans, because that's ultimately what the syndicators are having to deal with right now. It's not that they didn't think that interest rates could ever go up, right? They the banks were forcing them to buy caps, even if they weren't choosing to themselves. But there's a lot that goes around that. And I don't want to get into all of that right now, but I guess my point is from the investor side, the numbers will fall out the way they fall out. As the investor, how did I go in with a plan, with an expectation, and then how do I treat that now? Not just the actual decisions I make, but the emotions that come with it, because those emotions are going to dictate what I do moving forward. Right.
Rod, I have some strong feelings about this.
All right, let's hear it.
And my reason, the first thing that came to my mind was the episode we did about Dave Ramsey, or with Dave, where we were kind of debunking some of Dave's myths.
Yeah.
And if you recall, a lot of the ideas that Dave suggests are basically like, you don't have the ability to do the right thing, to do the things that make sense, that's logical and with the numbers. Therefore, you should do this.
Mm-hmm.
Right. So he's basically saying it's all about behavior. Right?
Yeah.
And because people don't have discipline and behavior, we're not even. So I had to break this into two parts.
Okay.
Because again, that first part that came to me was like, I was like, you can't just go tell people, like, give people the behavior that they need to do without having the validation of the actual numbers. Like, at the end of the day, my job as an educator is to teach people what really works.
Mm-hmm.
At least that's my belief, right?
Sure.
So I'm like passionate about this idea that when you're coming at it from an educator, you have to give people the real story. We can't just assume that they can or can't do it. We have to assume that everybody has the ability to, if given the information. So my problem, okay, so here's the way I look at it. From an educator standpoint, I 100% think that we have to focus on the numbers and teaching people how it works. And then we have to, get into the behaviors. Obviously those are kind of like obvious, Rod. Any adult knows that the behaviors have to be done with it. Like, and I'm not going to be there in their backyard or like sitting next to people and like making them choose not to go take a stupid loan out of their HELOC, right? What I can do is teach them that it's jackassery to do that, to buy something stupid because, they're losing real value from a numbers perspective.
Yeah.
Okay. So, but then you have to look at it from like a consumer investor perspective. And then it goes back to what you're saying. So here's my belief on this. I still think my belief is that it's about the numbers, or it should be about the numbers, but it often is about the behavior. Therefore what? That's kind of the question. And I think what we have to do as educators is teach people the numbers, teach people the logic, and then help them, with resources to be able to execute on whatever the strategy is they have in place. But again, I just feel like the numbers are super critical, Rod. I don't know the numbers, and I know everybody's going to say behavior is more important. But all I can say is if you're doing well, okay, I want to throw an example out there.
Okay.
Right. So this is really simple, like just very baseline, but we see this kind of thing all the time, right? Let's just say theoretically, this isn't even theoretical now that I think about it. This is like every day, right? So you go into a conversation with somebody and they're like, hey, I've got my emergency fund. I'm pretty nervous about it. So I went with a 5-year emergency fund, right?
Okay.
And I've got to make sure I keep that safe, liquid, close to me in the bank. So I'm just keeping it in my savings account, right? So I've got $500,000 in my savings account. And then Rod's over here and he's like, oh, well, I know what you could do to like get some more value out of that. Even if you want to keep it safe and liquid and all these other things, but you can also like grow it so that in 10 years, instead of still being worth 500,000, it's worth $800,000, right? As an example. And let's say there's no additional risk associated with it or very little. Okay.
Yeah.
So here's my thought. While they obviously have the choice to continue to put that money in a bank account and get no value out of it, it's just ridiculousness, right? at the end of the day, it's still stupid. So the numbers have to be followed. You have to actually look at baseline logic, right? I don't know what else to say about it.
Yeah, no, I hear what you're saying. And that's why, again, that's why it's a debate, right? It's kind of like, is it with kids, is it nurture or is it nature? Right. Again, I'm not going to get into that debate.
Little bit of both.
I'm just saying that it's similar because I picked a side because I feel like, that was the
reasonable,
more critical side, but I'm by no means saying the numbers don't matter, because they absolutely do. So in response to that, all I would say is that it's going back to kind of my idea of the plan. You can have a plan, and sometimes our plans are ridiculous, or at least the application
okay, and if
of
it is,
the plan.
I would say that's a stupid plan.
And I agree with you.
Okay.
Because again, were all my plans great? Okay, so having in that first mortgage, more than 50% of my income going towards
was a bad
the mortgage.
idea, Rod.
Was it
bad idea.
Was it great? And the other thing that we had is we had a 7-year arm, and I had people telling me, well, that's silly too, right?
Yeah, and
but we only
lucked out. You managed it though, huh?
As it turned out, we only had the home for a couple of years.
All right, so it worked out.
Anyway, it did, but understandably, there are situations and timing matters where maybe it wouldn't have worked out. So,
okay, Rod, couple more questions.
Okay.
And I have one that we could do a lightning round on. Do we want to do a lightning round?
Yeah.
Okay, I will. I'll do a lightning round here in just a minute. A couple more questions, a little more thought, and then we'll go lightning round style.
Okay, deal.
Okay, Rod, what do I do if I want to retire early, but I've saved all my money in qualified plans?
Too bad.
That's it.
I'm just kidding.
No options. Sorry. Good night. That's it. Okay. What are my options? What do I do if I'm that person?
Okay. Well, if that's all you've done, then there are some things you can do. There's the 72T, and we've talked about this a little bit in the past. But that only depending on how much you saved. Like,
yeah,
if you have $5 million and you only need 100,000 of income, then the
72T knocks it out.
Yeah, you'll be fine.
Okay.
But if you only have 2 million and you need the 100,000, not so much.
That's not going to work as well.
So, and you can just cash it out.
You can cash it out. Okay. So I think the obvious one is to do the Roth conversion, backdoor Roth, whatever you want to call it. They have, every time I go listen to new podcasts, they have like an extra word that's added on to the backdoor Roth. I think there's like the laddered backdoor Roth now, which is really important because I heard someone break it down and they were like, okay, so they broke down the backdoor Roth for what it was. I'm not going to go into that. But then they said, and laddered means that we do it every year. I know. Brilliant.
Yeah. Well,
anyway.
And I can see some wisdom in that, because if you don't have any forethought into it and you get into that 5-year rule, you do the backdoor Roth. And then if you don't wait 5 years before you start taking the income out of that, then.
Okay. So the key then is you've got to start planning before. Like that's kind of what you're getting at. You're basically saying, if I just get there and I've done no planning before that point in time, then my options are going to be pretty limited. The backdoor Roth doesn't help immediately, right? Or maybe not as much as I need it to immediately. And like you said, I have a 5-year rule that I've got to be dealing with. So it's not one of those things that I suddenly have access to all the money that I need. I have to make a plan ahead of time. Same thing. The 72T, obviously, like you said, you can get some money out of that, but it's difficult. So I think the moral of this story is don't put all of your money in qualified plans, particularly if you want to retire before that magic age of 59 and a half.
Yep.
Okay.
And if you find yourself in that situation where you have, get out of it. I mean, I'm not saying take all your money and move it all immediately, but do something more than what you have been doing up to this point.
Okay. So the first key is probably change the behavior, right? So you're like, I'm working. I'm not going to be able to retire now. I've got all my money in qualified plans, but the good news is next year I'm putting another 80K in my 401k.
Yeah,
Probably not going to work.
And that's what your CPA is going to keep telling you to do, if that's what they've been telling you to do. You have to look at it differently.
Don't do that.
Yeah, you're just digging yourself a bigger hole. And we've seen people where they say, well, I'm all in there, but I'll just move it over to a self-directed and go and invest it in real estate or in these other things. And I mean, we've just seen situations where people get 10 years down the line after having done that, and they just feel like they dug themselves a bigger hole, because on the one hand, they're really grateful about the growth they've been able to create, their ability to be more in control of what the investments are doing for them, but still not real happy about, okay, still now all that money is in these qualified plans, and now what do I do? And kind of this moment of panic of, oh, I'm 55, I want to retire, but I can't easily do that without just, taking some penalty and doing it.
Okay, Rod, this next question, this is the final question that we're going to get into detail on.
All right.
So once you're through this, you've got to start thinking short and fast.
Okay.
Like 3 word, maybe even 1 word answers. Okay.
Oh,
so just be prepared for that.
Well, this is something I like about you, Christian, is you prepare me for things like that. So thank you.
Yep. Okay. But you don't have to do that on this one, because this one's a little bit, it's going to take a little bit more context. I think this is a good question. It's a question we get periodically, fairly frequently. Do the capital avalanche and investment optimizer strategies work even for people who are older? And I'm thinking specifically 60 and up. Okay. Why or why not? What are you seeing out there? Maybe help give us an example. Well, I'm not actually, just go with it where you want to go.
Okay. Well, the answer is that it can. Okay. So I'll start there.
Okay.
A lot of people just assume
it's not
that
like an unequivocal yes or no. It certainly can. Okay.
Yeah. And really it just depends on the time frame. So let's start with investment optimizer first. Investment optimizer is something you're putting the money in. You're going to use those dollars for investing. There are some upfront costs to do that, which is true no matter your age, right? So it depends on how long you're going to plan on continuing to invest. If I'm starting an investment optimizer policy, I'm 60, I'm going to retire at 65, I'm going to do no more investing after that. So I plan on putting the money in and then being able or wanting to take it all back out when I'm 65, probably doesn't make any sense for me to do that, right? On the other hand, if I'm 60, I'm going to invest for the next, even if I'm just investing for the next 5 years, but I'm going to let the money be in the policy beyond that and methodically take the income out of it, then it absolutely can make some sense, right?
Okay. Yeah.
So that's the context.
Can I throw one other thought out on this?
Yeah.
So the other thought on the investment optimizer side, and really it applies to both, but we, in that stage of life, we can and have gotten creative in using like children as an insured inside of the multi-generational legacy planning concept that we've done a podcast on. So even in a situation, let's say that we have someone that's 72 years old, they're interested in the investment optimizer because they're still investing. They might as well be effective with it.
Yeah.
That could be an option. And like you said, age is probably less critical as it relates to the investment optimizer than it is in the capital avalanche.
Yeah. You do bring up a good point though, because there does come a point in time where the policy just isn't going to work. And as a general rule, when someone gets into their 70s, it's harder to build an efficient policy that will ultimately give you that value. Part of it has to do with time frame, and just part of it has to do with those costs.
Yep, that's it. I was just going to say most of it is a timing issue, right? Like it's not that it won't create value, continue to grow both from a cash value and death benefit perspective, but it won't hit the numbers that we talk about. So we're kind of using the standard being growing at around 5%. It's not going to do that if you're 72 years old, right? It's probably going to be 2 or 3%, and it's going to take longer to get to a break-even point. So I think those are things that are important. Okay, Rod, talk a little bit about capital avalanche, because that one has more of a has a longer waiting period.
Mm-hmm. And here again, it depends on your plans. Okay, so again, let's take someone who's 60 who says that I need to be able to start taking income at 65. Don't plan on that for the capital avalanche unless you have other assets and you kind of phase into your income, meaning you take the initial income from somewhere else, and then when you become 72, 73, then you're ready to start taking the income from the capital avalanche. Then that's great, right?
Okay, Rod. So here's a question I think you can answer pretty hard and fast for us. How long generally do you think someone needs to let the capital avalanche or a holding period before taking income from it?
Great question. In what we're generally showing in the webinars and whatnot, where you do a single contribution and then we're financing everything after that, plan on waiting 12 to 13 years before we're creating something that's meaningful coming back out.
Okay, so that's important, right? And the reason I asked the question is if you're 58 and you want to have money, you want to kick that money in at 70, then you're great. Like that's no problem, right?
Yep.
But if you're 65 and want to have it at 70, that's not going to work. So that I think that helps, because at the end of the day, we can all look at that and say, okay, if I need to let it bake for 12 or 13 years, then I know whether it makes sense. Okay.
Yeah,
But
and
you have a but to this.
Yeah, because there are things that we can do to speed that up. If instead of just doing a single year and then turning the financing after that, if you funded it for multiple years, like you're funding out of pocket for 2 or 3 or even more years, then we can speed that up. So you do say it's the 60-year-old and they're saying, well, maybe around 67, 68, I want to be able to start taking income off of this. Well, if we then fund it for 3 or 4 years before we start turning on the financing, now we're still getting leverage out of it, creating more income in the future than they would be creating on their own with just their dollars going in. But we're creating more liquidity, more equity going in, which means that we can start taking income sooner, more kind of meaningful income sooner, so we can hit that 7-8 year timetable.
You could also partially fund any given year, right?
Sure, absolutely.
So you could say, hey, instead of like maybe the total amount that's being borrowed each year is $200,000, and I'm going to put in, 50,000 every single. Maybe you put in 200,000 year one, and then you have some number that you just continually put in. Those kind of things we can do to be creative and run the numbers and see what works and makes sense for people. But here's the question then, Rod: is it worth it from your perspective? And this is hard because obviously you sell the concept, but like from your perspective, is it worth it? Like, is someone getting the same or similar value if they're not leveraging it as highly? They're putting more money, pumping more money into it.
I think it depends on the alternative. Because typically what happens is if someone says, well, if I wasn't doing this, I would be investing in real estate, and I'm very comfortable doing that. I have good success doing that. I have an expectation of what kind of return I can get, and confident in my ability to continue doing that, then their answer might be, well, I'm better off just continuing to do what I've done and seen success with and want to continue to do.
Now, that said, Rod, the real estate market has been hot for 12, 13 years, and suddenly things. So I'm guessing there's more people who are looking at this as more of a debate than they were in the past, right? If I was like, hey, I throw money at a syndication and make 20% no matter where I go, well, heck yeah. But if I throw money at a syndication and I'm worried I might not get my money back versus putting something in that maybe I'm only going to generate 10% IRR on, well,
or
it's a little bit more of a debate.
Back to what I said a minute ago about the timing of the syndication. If I'm putting that money in and I'm saying, well, I really am going to need that in 3 years, I'm counting on them turning everything around and giving me my money back in 3 years. Well, that's probably just an unrealistic expectation, or not something that would be wise going in to plan on.
Okay.
Right. So a lot of those other things would depend as well. But, so to your point, we have a lot of people who are saying, okay, well, I have this money that's building up over here, and in the past, I've really liked getting it into other investments, but maybe I'm in a place where I want to diversify, so to speak, away from some of those things and do something different and that builds in a different way, but still uses those same principles of leverage and whatnot, then it can be a good way to complement or kind of supplement what you've been doing on the other side.
Okay, Rod, I think we're going to leave that and we're going to move to our lightning round. Okay. So I'm trying to decide. I have like maybe 12 to 13 more questions. I think I'm going to do like 5 to 7 of them.
Okay.
So here we go. Okay, Rod. Number 1, save money before paying my expenses or after?
Before.
Number 2, use a credit card or just avoid credit cards altogether?
Use.
Oh, gosh,
I'm going with the one-word answers. Did you notice that?
Start my own business or work for someone else?
Oh, wow, that's a tough one. Me personally, I say work for yourself. Start your own business.
Okay. And here's the thing: we also encourage people to create side gigs and things like that because of like the tax benefits. So I think while it's not right for everybody to own and run a business, it's probably a good idea to start a business. Yep. Okay. Invest in like index funds or individual stocks?
Index funds.
Okay. Buy a home or rent?
Buy.
15 or 30-year mortgage?
30.
I thought you were going to say 40. That's what I was going to say. 40.
That would have been good. Yeah.
Oh, this one's really good, Rod. Whole life or term insurance?
A whole life.
I guess depends on the purpose. Say both.
But yeah, right. There's
okay, we'll say both. Pay off my student loans first or last? Ooh, talk to all the physicians out there that are, 48 and still have student loans. What do you think, Rod?
Yeah, I mean, I want to say last, but I also feel like I need to give some context on that because I'm saying that assuming that you still have a decent interest rate on that. If you're now paying 8-9% on that, then I would obviously feel different. And but if it's
Rod,
4,
that's all. Yeah, that makes sense.
Yeah.
I think what you're saying makes sense. Okay. I want to save some of our questions for later. So we're going to wrap this thing up. Okay. Before we do, I have a very specific request for our listeners. Okay. My request is if you found this episode or the Money Insights podcast valuable, please share with 2, not more than that, not 5
or less,
not 1. We need 2 of your friends, people that you think can get value from it. One of our goals over the next year is to really lock in and grow the podcast. So we appreciate all of the loyal listeners and the support you give us. And anyway, so thank you all for listening. We appreciate your support and we will see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.